All right, welcome to this week's episode of DoubleLine Minutes. I'm Jeff Mayberry with Mark Kimbrough.
How you doing?
It's 10 a.m. Pacific time, or like 10:03 Pacific time on August 9th. Seems like a pretty interesting week we had this week. If you did what Sam and I like to call the Rip Van Winkle portfolio, really nothing was going on, but there's a lot of vol intro week. So why don't we get right into it here? Week over week as of right now, 10:04 now. S&P down 27 basis points on the week. The tech sector up 12. The energy's up 1.5. Energy being the best performer. Industrials up 102. The second best performer. Looks like the worst performer, materials down 1.68%, followed by consumer discretionary down 1.15. Really, if you look at that, pretty quiet week. Russell 1000 down 36 basis points. Russell 2000 down 1.5%. S&P equal weight kind of showing how quiet the week was, down whopping 10 basis points. So pretty flat there from the equity side of things on a week-to-date basis. If we kind of shift over to the bond market, pretty quiet also. 2-year was up 16 basis points, 10-year was up 15 basis points. So pretty flat rise there in interest rates from the Treasury curve. Ag, that makes the ag down about 0.75 of a point. All government and agency mortgages down slightly more than that, around let's call it 80 basis points or so, and investment grade corporate bonds down 60. So that was the best performer of the on the week. High yield turning a very, very slight positive. And if we look at bank loans and emerging markets, both pretty much flat. So if you kind of look at this overall, stocks, bonds, pretty quiet. Obviously, there's some underlying volatility there. We did see some pretty large moves, especially in the stock market there on Monday. Follow through from what happened over the weekend. Follow through from Friday. The Friday mark, as you and Eric talked about last week, with the jobs report and the unemployment rate and the Somme rule and all that jazz, kind of flying through into Monday. But then kind of Tuesday reversed Monday, and pretty quiet for the rest of the week.
Yep. Just what a week.
Yeah, what a week. As we like to say, if you overreacted and you got scared and you sold on Monday, then sold your stocks on Monday, then that was obviously a bad move because you got that rebound. You did see a lot of people come out on, especially early in the morning. And Mark, you'll get into the macro side in a second. Something that kind of calmed markets, I think. I think it's 7 a.m. Pacific time that comes out. But before that, you had a lot of people coming on TV saying Fed needs to cut 50 basis points, emergency cut here before, because the next Fed meeting is not until September 18th. And it was like Fed's way behind the curve. We're in a recession right now. And obviously none of that came to fruition. So, it was pretty funny to see, or, actually at the time it wasn't that funny because, we didn't know what was going on. But now you look back and you think it's pretty funny to see all the people calling for all these emergency cuts, and here we are, down 27 basis points on the S&P on the week.
Yeah, it was funny. Given that panic, it was kind of nice that I'd say a number. I'm not going to name any names, but a number of places where retail people would trade their stocks, they weren't allowed to. They were kind of blocked out. So that saved some people from potentially selling at the lows before we had that snapback.
Yeah, saving them from themselves, and of course, exactly. When people were talking on Tuesday, no, I wasn't going to sell. I was going to buy.
Of course.
So of course they're going to buy the dip. But it was pretty interesting week from that perspective. Let's run it out with commodities. The BCom up 1% on the week. Energy, the big winner, up 4.8%. Every the other sectors were all negative. Well, I guess industrials was flat, but everything else pretty negative. Look at WTI today, $77 a barrel. Gold up $6 today to $24.34. So some pretty big moves there from the commodity side of things. But really, I guess that's the only positive sector. But really, we did a pretty quiet week if you week over week. But obviously, as we said, kind of a lot of intraday vol there. So Mark, why don't we get into the macro side and kind of talk about kind of what made people feel a little bit more comfortable on Monday?
Yeah, all right. Let's dive in. This was, this is the one we'll dive into the most because it was definitely the most impactful, it seemed like, on the week. So again, you said 7 a.m. we had ISM services get released for July. we'll say that came in for the rescue. It printed 51.4 versus an estimate of 51.0. As a reminder, from the diffusion indices, you want above 50 is expansion, below 50 is contraction. This was an improvement from the prior month where the ISM services had printed 48.8. Just for quick reference, over the last 50 months, we've only seen 3 prints below 50. 2 of them this year, 2 of them actually occurred this year. Each time we've had a little bounce back. The bounce has got a little weaker, but we're back in expansion, so that is a positive. But going into the details of this, the headline number is calculated from 4 figures taken with simple adder of. You have business activity, new orders, employment, and supplier deliveries. For 3 of these, business activity, new orders, and employment, all of them were in contraction in June. All of them snapped back strongly, say ranging from, a 5.1 point increase for new orders back to 52.4. You had business activity and production increasing 4.9 points to 54.5. And employment, I'm not going to say all the numbers, bouncing back into expansion. 51.5 for that. The only metric you had that didn't bounce back into technical expansion area is the supplier deliveries. Brief, we talked about this briefly, but the history on this, above 50 means products moving slower. The upstream suppliers to the service providers, it's moving slower. Below 50 means it's moving faster. The thought being that if you have a pickup in demand, things kind of get a little sluggish. But there's 2 quotes that came in this report that it's a counterintuitive concept, but there's 2 quotes I want to highlight. One, and it's regarding these supplier deliveries. Its distribution appears to have recovered finally from the long lead times during the pandemic. And 2, no delivery performance issues. You have sufficient supply on goods and services. So just taking those 2 anecdotes, the supplier delivery seems like what we call it normalized now. And all of a sudden goods flowing faster, I wouldn't take that as a negative. I take that as a positive because we're more concerned with inflation. So all in all, I'd say it was a good report for the ISM services. The employment number bouncing back to expansion was very positive. That helped alleviate some of the concerns that we got from the jobs numbers on Friday. So that was, rounded out the ISM services. It was a little bit of a help for the panic on Monday morning.
Yeah, definitely felt like that was the kind of almost the turning point where people saw that especially the headline print at 51.4 as like, oh wait, the world isn't collapsing. It's everything's not falling apart. We're not in a recession right now.
It felt like that in the morning, and then I fully agreed. Also on Monday, we got the SLOOS report, the Senior Loan Officer Opinion Survey on bank lending practices. I'll summarize this briefly in the context of the first quarter report and this report. You had loans for businesses for banks. You had lending standards continue to tighten to businesses, but demand in Q2 was weaker. Demand weakened in Q1. In Q2, you can argue demand kind of stabilized for loans for businesses. Loans for CRE, same story as Q1. Standards got tighter, demand got weaker. It's not lightened up there yet. And finally, you have loans for households. In Q1, we're mixed relative to them. Last quarter, you had tightening lending standards for all categories, for all household categories. This time, you had a few remain unchanged. In Q1, demand was noted to weaken everywhere. This time, you got some unchanged demand in a couple categories. Credit cards being one. But so call it a little stabilization there. Nothing too crazy from that report, but an improvement from Q1. On Wednesday, we got consumer credit. I talked about this last month. Trying to look at the long-term moving averages. These numbers can be pretty volatile. For consumer credit for June, there was an expansion of, let's call it around 8.9 billion. That was down from the prior of 13.94 billion. Well, again, last month talked about this breakdown between revolving and non-revolving credits. We've had a pickup in credit card use on a relative basis compared to trailing 5, 10, 20-year averages. And we've had a decrease in non-revolving credit in the last 2 years, 1 year relative to those 5, 10, 20 moving averages. This month, of course, we got something entirely opposite direction. You had a big pickup in non-revolving credit and a decrease in revolving. And not much reason to dwell on that, but credit's still expanding. Also, we got on Thursday, you had continuing claims and initial jobless claims. The initial claims came in at 233K, 7K below estimates of 240, and that was a 17,000 decrease from last week's prints of 250. I mentioned that decrease because that's actually Largest decline we've seen since September 2023 at 17K. Significant contribution to that decline is thought to be coming out of Texas. There was a spike in claims we saw in the last few weeks in response to Hurricane Beryl. Hope I pronounced that correctly. But the 4-week moving average of initial claims did rise to 241K versus a prior 238K. We're still below the summer peak from last year, but it still has been trending up. We'll see if that kind of normalizes as these some of these storm numbers roll off. Continuing claims printed in line with estimates, 1.875 million. It's a 6K increase from the month prior. This has now risen for 12 consecutive weeks. It's highest it's been since the recovery. Continue to monitor this. I mean, the number is still low historically speaking, but the trend is up. And that kind of wraps up the week. There were some wholesale numbers on Thursday, but they're nothing to write home about. So I'd say leave it there.
Yeah, it's pretty much like the quietest macro week I can think of.
Yes.
We a couple data, obviously you get jobless claims every week, but you just had kind of a couple data prints on Monday that were kind of, I guess, market moving. If we kind of roll back, Fed speak, there was really not much going on. There were some people out on Monday kind of saying, we'll do what it takes to, not whatever it takes, but we'll do what it takes to kind of keep things in line. And I guess that makes sense. And we haven't really, nothing really post Monday that really caught my attention there. We do look at the interest rate probabilities. We're now looking at, we're at 4 cuts here for till the end of the year, 1.5 cuts priced in for September. Now, and obviously that means that there's some probability of a emergency cut before the September meeting, but there is that 1.5% by September 18th, another cut in November, and then another, looks like 1.25 or so in December. So it'll be interesting to see. We were at the depths of despair on Monday. Market was pricing in 100% probability of a 50 basis point cut by September 18th. So kind of walk that back a little bit, but still 4 cuts in 3 meetings for the end of the year. It's pretty sizable cuts there. With that, things to keep an eye on for next week. It is a inflation week. So on Tuesday, we do get PPI. That number is expected to come down a little bit. The final demand year over year at 2.3 from a 2.6 prior, and ex-food and energy at 2.7, down from 3. So that would be welcome news from the inflation front. CPI on Wednesday. The headline CPI expected to be 0.2, up from a negative 0.1 last month. And the core CPI at 0.2, also up from a positive 0.1 last month. So we'll see how those kind of shake out. We have pretty low base effects from last year. So if we do get that 0.2 in headline CPI, that leaves year over year flat at 3 and core at 3.2, down from 3.3. So we'll see whether, Mark, you did mention that inflation is still important. And obviously it is. But it does seem that the Fed is starting to shift its focus towards growth as opposed to inflation. But obviously a bad print here could kind of shift that focus back towards inflation and away from growth. We'll also get to see the retail sales numbers on Thursday. We'll see whether that consumer continues to keep the economy strong. We get the month over month. This is the advanced month over month for July, expected to be 0.4, up from flat last month. Ex autos and gas was 0.8 last month, expected to fall to 0.2. And the so-called control group, which is what goes into the GDP number, expected to be 0.1 from a 0.9. So last month's retail sales were super strong. So kind of more normalization there from that side of things expected. We got jobless claims on Thursday, import prices also on Thursday. Import prices is something we like to look at from an inflation standpoint. The month over month number expected to be negative 0.1 from a flat. So that would be good. That would be also helpful from inflation. And then on Friday, we do get the University of Michigan long-term inflation expectations. Make sure that doesn't get out of line there. Expected to be, I guess it was 3.0. We don't have an expectation on there. So we'll see whether that kind of ticks down or up here. But right around that 3 level looks like it should be okay. And that should round out the week. So it could be a pretty volatile week there. Obviously, August tends to be a little bit, people tend to be on vacation. So you do get a little bit more volatility. Everyone always makes the joke that the junior traders are on the desk, so they tend to overreact to things than the old hands who have been through this before. So there could be some vol, but it'll be interesting to see how things shake out there from the macro front. And with that, I mean, we said short week, not much going on after Monday. So I guess we can just wrap it up there, Mark. And I'd like to thank everyone for tuning in.
Yes, thanks to all our listeners out there today on DL Minutes. Hit us up on the X at DL Minutes, D-Line Minutes, or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
Yeah, don't forget to check out our YouTube, youtube.com/double-line capital. We do have Jeff Sherman's CNBC appearance up. Definitely worth watching there. And also, Mark, as you mentioned, the weather in the jobless claims numbers. Also, there's some discussion about whether the weather affected the jobs report from that we got last week. The BLS says there was no effect, but people are trying to say that maybe the BLS was actually saying there was no effect from their response rates, but that doesn't mean the numbers weren't affected by the weather. But you can check out our blog, the Between the Lines blog called Bad Weather, for this week to get a little bit more in depth on that. And so I think that's definitely useful and something that people could, should take advantage of reading it. It takes about a couple minutes to read, so it's nice and short there. Again, thanks for everyone for tuning in, and hope everyone has a great weekend.
Yeah, thanks everyone. Stay safe out there.